Now, let's talk a little bit about the VectorVest system. VectorVest analyzes, searches, sorts, ranks, and graphs over 13,500 stocks a day for value, safety, and timing. So how do we go about doing that? As I indicated earlier, if people are thinking about picking a stock, the first thing they look at is PE ratios. Well, we're beyond that now. So if you're using the VectorVest system, the first thing you probably want to look at is the price of the stock and the value. And what I've got here, as of August the 10th, I've got 4 sample stocks, and I've got the value that VectorVest calculated on that day, okay? And we can see that McDonald's is undervalued, Cisco is way undervalued, Nighthawk, whoever they are. Anybody know about Nighthawk? Absolutely, absolutely. They're radiologists. They analyze radiographs. They do it at night, and you email them the chart, and they analyze it and email you the answer. Okay? Nice business. All right, and then we got L'Oreal Space, and here you got 40 and 26. So immediately, you may have a little problem there. Mark, let's move ahead. All right, then we have a thing called relative value. Relative value is an indicator of long-term price appreciation potential. We look at price, value, earnings, growth rate, earnings growth, AAA corporate bond rates, and risk are used to compute relative value. In other words, what we do, we look at that little chart we have, we say, well, here's the price and here's the value, okay? Would I buy that stock? And what we say, well, first of all, I got to look at AAA corporate bond rates. Well, if AAA corporate bond rate is paying 6%, and over a 3-year period, it give me about 20% gain. Is this stock going to do that? Well, you say, well, if the price is below the value, chances are that's pretty good. But that isn't all we look at. We say, what is the probability that the earnings growth rate of that company is going to continue? So we have to look at an assessment of the probability of that happening. Okay, and that assessment comes from the analysis of the consistency and predictability of financial performance, which is built into RS. Okay, and also we look at all this stuff and we do what is called a discounted cash flow analysis. In other words, we bring that value at the end of 3 years back to the current day. All right, and voila, we have relative value, and let's take a look at it. So Cisco Systems has the highest relative value, 1.5. L'Oreal Space has the lowest, 0.66. And what this says is that Cisco Systems has the potential probability of going up and returning 50% more than a comparable investment in AAA corporate bonds, while L'Oreal Systems would be 34% less than an investment in AAA corporate bonds. Now, to me, this is the best indication of value. We call it relative value because everything is on a scale of 0 to 2. Values above 1 are favorable, values below 1 are unfavorable. And what we're doing is we're building a structure, a framework on how we can analyze a lot of data with a click of a mouse. Okay, let's move forward, Mark. The next thing we want to look at is relative safety, consistency, and predictability. Financial performance are the primary factors in assessing relative safety. Let's move on. All right, and we look at a lot of things. We look at quarter-over-quarter performance, year-over-year performance. We look at debt equity, look at the size of the company. We look at the volatility, a lot of things. And when it's all is said and done, believe it or not, Cisco comes out on top at 136. I was surprised by this number. McDonald's for years has been higher than that, but McDonald's took a loss recently. They sold their business down in South America at a loss, and so they had to report a loss. And when they take a loss, boom, the relative safety goes down. L'Oreal is below average, and Nighthawk here, their relative safety is 0.66. And Nighthawk's a fairly new company, doesn't have a lot of history to base it on, and when we don't have the history, we don't give them the benefit of the doubt. We just say, well, we got to assume they're risky until they build up that track record. So here again, values below 1 are unfavorable, values above 1 are favorable. The next indicator is relative timing. And of the 3 indicators, this is the most important indicator. The next most important indicator is, guess what? It's relative safety. The least important of the 3, believe it or not, is relative value when you're making an investment decision. People on Wall Street talk about value, value, value all the time, but very few of them know anything about value. They never talk about safety. But my experience in using this system over the years is that relative timing is the most important, relative safety is the next most important, and relative value will come along for the ride. Let's think about it. If you have high relative safety and high relative timing, you really don't care what the relative value is anyway, right? If you have a high relative safety, you're typically going to get pretty good relative value.
On your VST, is the safety then have a larger impact than your factor?
Excellent question. The question is, in VST, does relative safety have a higher impact than relative value? And the answer is yes. In fact, we use a coefficient in front of RV of 0.9. We use a coefficient of 1 on relative safety. We use a coefficient of 1.1 on relative timing. Timing is overweighted, relative value is underweighted. Mark, let's go ahead. Here we are, stocks ranked by RT, and Cisco happened to be up there at the top. Nighthawk was right there with him. McDonald's was languishing, and poor old L'Oreal wasn't doing so well. And if the number is above 1, that is a favorable, below 1 is unfavorable. And I forgot to tell you on that previous slide, when we do RT, we look at RT, we're looking at the direction of the price movement, up or down. We're looking at the magnitude of the price moving. How far up is it going and how far down is it going? And we look at the dynamic. How fast is it going up or how fast is it going down? And then we look at various time frames. We look at day over day. We're using closing prices. We're looking at day over day, week over week, quarter over quarter, 13 weeks over 13 weeks, and year over year. The most important time segment is 13 weeks. Okay. Now we're developing real time, so we're looking at the time that we have in real time, whatever that price is versus the previous day's close. Okay. This indicator is a very smart indicator. It's very smart. It's got a lot of stuff built into it. And maybe we'll see some evidence of that later. The master indicator is VST-Vector. It combines RV, RS, RT in a single comprehensive indicator. Let's look at it, Mark. And what we do is we take the square of RV. This would be 1.5 squared plus 1.36 squared plus 1.24 squared. Now we multiply this one by 9/10, that by 1, this by 1.1. We take the square root of the sum of the squares. A lot of us learn that formula in high school physics. That's a vector formula, and that's where the name came from. And then we got to divide this sum by 3, because I want to normalize it back to 2. Because if I had 2 squared, 2 squared, and 2 squared, that'd be 4 plus 4 plus 4 is 12, okay? And I got to divide that by 3. I get the number 4. The square root of 4 is 2. So I normalize it back to a scale of 0 to 2, and anything above 1 is favorable, anything below 1 is unfavorable, and no surprise, L'Oreal comes out here at the bottom, and Cisco Systems is hanging there with the best set of numbers. Mark, let's move forward. Growth rate is so important, we feel it's important to report it to you. What we do is we look at historical data, 10 to 14 years of data if we got it. We buy forecasted earnings data from Thomson Financial, and we tie together the historical and the forecasted data as used to compute our growth rates. Let's move on. And so here are the growth rates that we have for these stocks, and Nighthawk, being a young company, pretty good earnings growth. It's got a forecasted earnings growth rate of 24%. And that forecast is good 1 to 3 out, 3 years out. And I usually say, it's good for a year out, okay? And our forecasted earnings are looking more at the future than what do we got today versus the history, which a lot of brokers and people use. Cisco's got 20, and poor little L'Oreal is sitting there with a -7. So far, do you think you would buy L'Oreal instead of Nighthawk? Should be fairly obvious. But watch, okay? The next thing we have is a stop price. All right? It's an indicator of when to sell or cover a position. This is based on a 13-week moving average of the closing prices of that stock and is used to compute stop prices. Let's move forward. And here are the stop prices. Now, we say it's an adjusted moving average of the closing prices. In other words, if we're looking at McDonald's has an RV of 139 and an RS of 129, we would tend to lower that stop price because we want you to get into it faster as the price of that is going up and want you to stay in it longer. The price is coming down. If we're looking at, where's my friend L'Oreal here? RV and RS, both below 1, we would push that stop price higher because if the price of that stock started going down, we want to see it go below the stop price faster. We want to get you out of that fast and get you into it slower. Make it more difficult to get into it, easier for you to get out of it. And so our stop prices are all tailored to the individual stock. People say, well, use a 10%, or Neil says, use a 7 or 8%, and that's when you first buy the stock, okay? And that's not a bad rule of thumb, actually. But ours, you will see in some cases, are more than 10%. Some cases are less than 5%. But here are the stop prices. Now, for the final. The bottom line, all factors are considered in making a buy, sell, hold recommendation. All right, let's look at that. And here we go. We have recommended B stands for buy, H stands for hold, and an S stands for sell. Now, how do they get these recommendations? There's several things that have to happen. The first thing that has to happen, the very first thing, is the price has to be above the stop price. If the price is below the stop price, it's automatically going to get a sell. Doesn't make any difference what stock it is. Here, the price is 40.34. The stop price is 41.33. Bingo, you got a sell. Now, McDonald's, the price is above the stop. Pass that test. The RT is 0.96. That's below 1. And if the RT is below 1, it's not going to get a buy. Okay? The VST is above 1. Pass that test. And it has to have decent fundamentals. It's got quite decent fundamentals. But the RT is not above 1, so it can't get a buy. It gets a hold. Here, Nighthawk, price is above the stop. Fundamentals are fair. But the RT is 124, which is well above 1, and the VST is 107, which is above 1. So bingo, it gets a buy. Same thing with Cisco. There's one other thing that we look at that you can't see here. And we constantly monitor the distance between the price of the stock and the stop price. And if we see the price is pulling away from that stop price, we'll tend to give it a buy. And if we see that price is moving back down towards the stop, it'll get a hold. If it crosses the stock, it gets a sell. So those are some of the things you want to watch. Hey, it's noon exactly. What do you say we get some lunch, huh?